Imagine waking up, pouring your morning coffee and glancing at the news, only to see Wall Street lit up in red. The Dow drops 1,100 points. It hits you like a gut punch. You've seen market dips before, 2008, 2020, but something about this feels different. Less like a correction, more like a warning. So what happened? Was it a sudden economic shock? A surprise from overseas? Or was it just a tweet? This time, it wasn't a war or a recession. It was a post on social media. One line from a former president calling on the Federal Reserve to cut interest rates rattled the markets more than a poor earnings season ever could. And just like that, questions started swirling. Not just among traders in suits, but among people like you and me. Retirees watching their 401k shrink, small business owners wondering what the next month will look like, seasoned Americans who've lived through the ups and downs of an economy that doesn't always play fair. But the real question is bigger than one tweet or even one market crash. It's about power. Who holds it? Who protects it? And what happens when it's pushed too far? Today, we're not just talking numbers and graphs. We're talking about the unseen battle between politics and policy, between short-term wins and long-term stability, between a president who wants to move fast and a Federal Reserve that was built to resist that very urge. So stay with me, because what's happening behind the scenes may not just shape the next headline. It could shape the next decade of your financial future. You know, market crashes never happen in a vacuum. There's always a story underneath the numbers, one that doesn't show up on a chart but plays out behind the scenes in meetings, in politics, and sometimes on social media. Let's rewind a bit. Imagine this. China quietly signals to its major trading partners, Japan, South Korea, the EU, that they should think twice before doing business with the United States. No official press release, no grand announcement, just back-channel pressure. Then, just as markets are trying to make sense of the ripple effects, President Trump, never one to stay silent, fires off a post demanding that the Federal Reserve slash interest rates. Now you might think that's just politics as usual, right? But here's the thing, markets hate confusion. Investors aren't just reacting to data, they're reacting to uncertainty. And when it comes from the top, it shakes the foundation. Let me give you an example. Back in 2018, when Trump tweeted about imposing tariffs on Chinese goods, markets dropped within hours. Not because the tariffs were active yet, but because investors knew what could come next. Retaliatory tariffs, supply chain disruptions, rising costs. It wasn't just a tweet, it was a signal. And markets read signals like smoke before the fire. That's exactly what happened here. China's quiet economic maneuvering already set nerves on edge. But then Trump's post made it look like monetary policy, the most sensitive tool in the U.S. economic toolbox, was up for grabs, like some political pawn. To me, that's where things really crossed a line. I've seen volatile markets before. We all have. But this feels different, because the institutions we once thought were immune to politics, the Federal Reserve, international trade agreements, are now being pulled into the fray. And if you're someone who remembers the impact of 2008, or who watched savings dry up during COVID, you know how quickly confidence can vanish when leadership wavers. So when we saw the market drop 1,100 points, it wasn't just about interest rates. It was about fear. Fear that the people in charge aren't playing by the old rules anymore. And when the rules shift, everyone pays attention. But that leads us to another big question. If the president really wanted to push the Fed to act his way, could he? Let's talk about that next. Because the power struggle between the White House and the Federal Reserve isn't just theoretical, it's constitutional. Here's a question that's been quietly sitting in the background, but now it's front and center. Can the President of the United States actually fire the chair of the Federal Reserve? At first glance, it might seem like a straightforward yes. After all, the president appoints the Fed chair. Shouldn't he be able to remove them too? But here's where things get interesting. Legally speaking, it's not that simple. The Federal Reserve Act only allows for the removal of a Fed chair for cause. That means the person would have to be guilty of inefficiency, neglect of duty, or malfeasance in office. And no, disagreeing with the president's economic agenda doesn't count. There's no legal precedent in modern history for a president firing a Fed chair, not even during some of the most turbulent economic times. Take Richard Nixon, for example. He was deeply frustrated with Fed Chair Arthur Burns for not cutting interest rates fast enough. Rather than fire him, which Nixon likely couldn't have done, he tried behind-the-scenes pressure and intimidation, even going so far as to plant loyalists within the Fed. The result? Long-term inflation and a legacy of damage to the Fed's credibility. Or look at Jimmy Carter and Paul Volcker. Volcker made wildly unpopular decisions, raising interest rates to record levels to fight inflation. It caused a recession, spiked unemployment, and nearly tanked Carter's re-election. But Carter didn't remove him. Why? Because Volcker was doing what the Fed was designed to do, act independently, even when it's politically inconvenient. Now, I'll be honest with you, I admire that kind of long-game thinking. It's easy to want quick fixes, but steering an economy isn't about pleasing the polls this month. It's about protecting purchasing power for the next 10 years. And when a president tries to interfere with that independence, it sends a chilling message, not just to economists, but to everyday Americans. Because if monetary policy becomes a tool of politics, what happens to your mortgage rate, your savings, your retirement? To me, this isn't just a legal debate. It's about trust. Trust in institutions that were built to outlast any one administration. And when that trust cracks, the ripple effects go far beyond Washington. So no, the president can't just fire the Fed chair, not legally and not without undermining decades of stability. But let's go deeper. Why does the Federal Reserve's independence matter so much in the first place? And what happens if that foundation starts to shake? Here's something worth thinking about. What would happen if the Federal Reserve stopped being independent? It sounds like a technical question, maybe even a little dry, but in reality, it's the kind of shift that could ripple straight into your grocery bill, your mortgage, and even the value of the dollar in your wallet. Let's rewind the clock for a moment. Back in the 1970s, political pressure on the Fed was intense. President Nixon wanted lower interest rates, especially leading into an election year, and Fed Chair Arthur Burns obliged. The result? Inflation skyrocketed. We're talking double digits, up to 14% at its peak by 1980. People's savings eroded, retirement accounts were crushed. It took years and the very painful leadership of Paul Volcker to bring things back under control. That's not just history, that's a warning. You see, the Fed was designed to be politically insulated for a reason. Unlike Congress or the White House, it doesn't run on election cycles. It doesn't make decisions based on polls. Its job is to play the long game, to protect the value of the dollar, to control inflation, and to keep the financial system stable, even when it's unpopular. And that independence? It's not just symbolic. Alan Greenspan, one of the longest-serving Fed chairs, once said, "If you are too political in your decision-making, you will create long-term economic instability." He knew how fragile investor confidence could be. And here's the thing, markets don't just react to policy, they react to perception. When investors believe the Fed is acting under political pressure, it shakes the entire foundation of the financial system. People start to question whether interest rate moves are meant to help the economy or help the president. Personally, I think this is one of the most underrated threats to our economic future. Because once that line between policy and politics blurs, it's hard to draw it back. And for those of us who've lived through economic crises, who remember the housing crash, the dot-com bubble, the 1970s inflation, we know how quickly confidence can erode when institutions stop doing what they were built to do. So yes, the Fed must stay independent, because when it doesn't, we all pay the price. But that brings us to another side of the story, how trade wars, tariffs, and international relationships can affect the very same economy the Fed is trying to stabilize. Let's talk about that next. Let me ask you something. Have you noticed your grocery bill creeping up lately? Or maybe your favorite local shop suddenly raised prices. Or worse, shut down completely? That's not just inflation. That's the ripple effect of something much bigger. Something we usually hear about in the form of political sound bites and trade war headlines. But let me be clear, trade wars are not just about diplomats, tariffs, or negotiations between countries. They're about you. They're about your everyday costs, your job security, and your financial peace of mind. Take the US-China trade tensions, for example. When tariffs were imposed on Chinese imports, the immediate goal was to protect American industries. But what actually happened? Many American businesses, especially small ones, faced higher costs for materials. That meant they either had to pass those costs on to consumers or absorb the hit themselves. Some couldn't survive either option. I recently spoke with a small business owner in Illinois who runs a kitchenware company. He told me that his raw materials, mainly stainless steel and packaging, went up 20% in just a few months after tariffs kicked in. He had two choices: raise prices and risk losing customers, or lay off staff to keep the lights on. Neither felt like a win. And that story? It's not rare. Across the country, trade uncertainty has left farmers wondering if their crops will sell, manufacturers delaying investments, and consumers paying more at checkout. I know there are people who say, it's just part of the bigger picture, we're fighting for fairer trade. And sure, I get that. Fair trade matters. But the question is, how much pain are we willing to take in the short term, and who's being asked to carry that burden? Because when the headlines fade, the economic consequences remain. And often, it's the folks who can least afford it who get hit the hardest. From where I sit, trade wars should never be waged through tweets or posturing. They require strategy, diplomacy, and most importantly, transparency with the public about what's at stake. So yes, trade wars are very real. And no, they're not just about numbers on a spreadsheet. They affect people, families, workers, business owners. Now let's talk about the proposed solution. Interest rate cuts, are they really the fix politicians claim they are? Or could they backfire in ways we're not fully prepared for? Stick with me. This part might surprise you. Lower interest rates. On the surface, they sound like a gift. Cheaper mortgages, easier loans, boosted spending. What's not to like? But here's a little secret that doesn't always make the headlines. Lowering interest rates isn't always the rescue plan it seems to be. In fact, if it's done too fast or too often, it can quietly plant the seeds of a much bigger problem, one we've seen before. Let's break it down. When the Federal Reserve cuts rates, the immediate goal is to stimulate the economy. It encourages borrowing, which can lead to more spending, more jobs, more growth. And in the right context, it works beautifully, especially in a crisis like the 2008 recession or during COVID-19, when emergency action was essential. But what happens when rates are slashed in an already heated economy? You risk feeding inflation, and not the manageable kind. We're talking about a cycle where prices rise faster than wages, where your dollar loses value day by day, where the cost of groceries, gas, and housing starts to outrun your paycheck. Let me show you something. If you look at a historical chart of the Fed funds rate alongside inflation, you'll notice a trend. In the 1970s, the Fed kept rates low under political pressure. Remember Nixon and Burns? Inflation didn't just rise, it roared. It took Paul Volcker hiking rates to nearly 20% in the early 80s to finally bring inflation back under control. And that wasn't painless. It triggered a deep recession, widespread layoffs, and high borrowing costs that lasted for years. That's the trap. The short-term relief of a rate cut can lull us into a false sense of security until inflation comes knocking. Personally, I understand the appeal of rate cuts. For homeowners, for small business loans, even for stock market gains, it can feel like an economic pick-me-up. But if we don't apply it wisely, we risk repeating the very cycles so many of us have already lived through. I believe we need to trust the Fed to look beyond election cycles and short-term polls, to resist the pressure of fast fixes, because when rate cuts are used as political tools instead of economic ones, the long-term consequences can be devastating. And that brings us to the deeper question. Why are we even in a position where the Federal Reserve is under this much pressure in the first place? Let's take a closer look at how the media, political narratives, and public opinion have twisted the Fed-White House clash into something far more complicated. Let me ask you something that doesn't get asked enough. Are we hearing the whole story when the media reports on the Fed-White House clash? Because lately it feels like every headline is a soundbite. Trump lashes out at Powell. Biden backs the Fed's independence. Markets fall on mixed signals. But the truth, it's more nuanced and more important than most media coverage will let on. Here's the thing, when the relationship between the White House and the Federal Reserve makes headlines, the coverage tends to focus on the drama, not the substance. Who said what? Who clapped it back? Who's winning the power struggle? What gets lost is the why. Why does this tension exist? Why does it matter? And how do different political ideologies shape the future of our economic policy? Let's pull back the curtain a bit. Traditionally, Republicans tend to favor tighter monetary policy. They talk about reducing inflation, limiting government intervention, and keeping interest rates in check to avoid overheating the economy. Democrats, on the other hand, often support looser monetary policy when needed, using rate cuts and stimulus to spur employment and growth, especially during downturns. But lately, we've seen both parties blur those lines. Trump, for example, pushed aggressively for rate cuts despite running on a platform of conservative fiscal responsibility. At the same time, Democrats have voiced concerns about inflation and central bank independence, particularly as it relates to wealth inequality. And here's where the media often misses the bigger picture. This isn't just about which party is right. It's about how political cycles are now bleeding into monetary policy. And that's risky, because when economic decisions become campaign tools, the long-term goals get lost in the short-term noise. And what's really at stake isn't who holds power today. It's whether we're preserving the institutions that protect our economic future. I'll be honest, I don't think either side has all the answers. But I do believe we need a smarter conversation, one that acknowledges that stability, trust, and transparency are more valuable than any tweet or press conference. We need to ask more from our media, and we need to look beyond party lines to understand what's really going on. Now, as we near the end of this journey, let's bring it all together. Let's revisit what we've learned and what it means for you, your family, and the future of the U.S.'s economy. Let's take a moment to breathe and step back. Over the past few minutes, we've seen just how fragile the system really is. Markets don't just move on numbers, they move on trust. And lately, that trust has been shaken. We've talked about the Federal Reserve, why its independence isn't just a formality, but a safeguard. We've seen how political pressure, especially when aired publicly and aggressively, can send shockwaves through global markets. And we've learned that tweets aren't just noise, they're signals. They can alter investment decisions, shake consumer confidence, and shift the global balance in ways most of us don't see until it's too late. The truth is, the Fed is supposed to be boring, stable, predictable. Because when the people setting interest rates start getting dragged into political theater, the whole economic stage starts to tilt. So what does this mean for you? Well, if you're an investor, a homeowner, a retiree, or just someone trying to stretch their paycheck, this matters. Because policy confusion leads to market volatility. Volatility leads to fear. And fear, more than anything, can stall an economy. But here's the good news. You're here. You're paying attention. And that is the first step. It's easy to get lost in headlines that scream but don't explain. But if we want to protect our futures, our savings, our businesses, our children's opportunities, we need to look deeper. Ask the hard questions. Challenge surface-level narratives. Don't just follow the noise. Follow the consequences. So what should you do now? Stay informed, stay skeptical, and stay engaged. Comment your thoughts below. What stood out to you most? Did this shift how you view the relationship between politics and the economy? I'd love to hear from you. If this video opened your eyes even a little, share it. Someone in your circle might need to hear this today. And don't forget to subscribe. Because we're just getting started, and you deserve to be part of every conversation that matters.